Usually when we talk about financial traps on this show, we're talking about obvious scams.
Right.
Nigerian princes, crypto rug pulls, things that just scream, stay away.
Hmm.
But I was reading through this new stack of research on debunking common wisdom, and it posits something much more disturbing.
That the worst advice isn't the stuff sold by con artists in dark alleys.
No.
It's the stuff embroidered on pillows and printed on coffee mugs.
Exactly. The catchy one-liners, the common wisdom. And the source material today, it goes straight for the throat of maybe the most famous investing mantra of the last 50 years.
Yeah.
It argues that this specific piece of advice, which sounds so intuitive and safe, is actually a primary driver of portfolio underperformance.
It's the silent killer argument. I mean, if you fall for a Ponzi scheme, you know it because your money is gone overnight.
Instantly.
But if you follow this flawed wisdom, you might just bleed out slowly for 2 decades, underperforming the index by like 3% a year.
And you don't even realize it.
You don't realize you're in trouble until you're 65, and the math just doesn't work.
So the mission today is a bit of an iconoclasm. We are going to dismantle the golden rule of retail investing. Invest in what you know.
Which, to be fair, was popularized by an absolute legend, Peter Lynch.
Right, and that's where I want to push back a little right at the start. I mean, Peter Lynch ran the Magellan Fund. He returned something like 29% annually for over a decade.
Unbelievable numbers.
So if he said, invest in what you know, and he beat the market doing it,
Yeah.
aren't we being a little arrogant to say he was wrong?
If he actually did what people think he did, then yes, we absolutely would be. But the source makes a really, really critical distinction here.
Okay.
The Peter Lynch strategy that the public knows is a caricature, it's a myth. The reality of what Lynch did is vastly different from the buy what you know bumper sticker.
Okay, lay it out. The story everyone tells is that Lynch would, go to the mall, see a line at Dunkin' Donuts or the Gap,
Yep.
and buy the stock.
And that is the dangerous oversimplification. Lynch did use his eyes. He used his daily life for idea generation.
Step one.
That's step one. He sees the line at the donut shop and he writes down the ticker symbol. But step two, and this is the part retail investors always skip, is that he went back to the office and tore the balance sheet apart.
So he didn't just like the coffee?
No, he liked the coffee.
Yeah.
So he checked the price to earnings ratio. He looked at their debt service coverage. He looked at same store sales growth versus their expansion costs. He only bought it if the financials supported the anecdote. The source argues that invest in what you know was supposed to be the invitation to research, not the conclusion of it.
But the problem is, most of us stop at the invitation.
Yes.
We like the product, we buy the stock, and we call it research.
Precisely. And the data in this research stack regarding that approach is, well, it's brutal. They highlight 2 case studies that I think really encapsulate the danger here.
Which are
Peloton and Allbirds.
the darlings of the pandemic era. And look, I get where this is going, but let's play devil's advocate for a second.
Go for it.
If I bought Peloton in 2020, I wasn't just guessing. I knew the product. I owned the bike. My friends owned the bike. The classes were full. I mean, that feels like hard data, doesn't it?
It feels like data, but it's consumer data, not investor data.
What's the difference?
You saw demand, you didn't see valuation.
Okay, so let's look at the scoreboard. The source provides a hypothetical. You invest $1,000 in Peloton and $1,000 in Allbirds at their absolute peaks because you love the products.
Okay.
And we are fast-forwarding to the date of this report, January 15th, 2026.
Walk us through the carnage.
Peloton peaked at $167.42. As of this report in early 2026, it's sitting at $6.72.
That's a 96% drawdown? Roughly?
Your $1,000 is now $40.14.
Wow.
You can't even pay for 1 month of this subscription with the remaining capital.
And Allbirds. I feel like this is going to be worse.
This one is even rougher because the brand felt so ubiquitous, especially in tech circles. Peak price, $577.80. Price as of Jan 15, 2026, $4.15.
Wait, say that again.
Your $1,000 is now worth $7.18.
$7.
That is a 99% loss. You have effectively gone to zero.
And this is where we have to analyze why. Because the listener might be thinking, well, those are just 2 bad picks. The market crashed. But that's not it.
Right.
The source emphasizes that the invested in what you know fallacy. It blinds you to the difference between a great product and a great business model.
It's the halo effect, right?
Yeah,
I love the shoes, therefore the stock must be a winner.
exactly. Take Peloton, great product. People were addicted to it. But the business model had massive fixed costs and was relying on a demand curve, the pandemic lockdown, that was inherently temporary.
Hmm.
As an investor, if you looked at the trend versus fad dynamic, you would have seen that they were pulling forward like 3 years of demand into one.
So the consumer sees everyone is buying bikes. The analyst sees everyone who wants a bike just bought one, so who is going to buy one next year?
Correct. And then you have the valuation disconnect. At $167 a share, Peloton was priced as if it would become the only way humans exercised for the next century.
Right, the market priced in perfection.
And when you pay for perfection, any slight deviation, a supply chain snag, a gym reopening, it crushes the multiple.
That's the key word, multiple compression.
Right. The earnings might drop 20%, but the stock drops 80% because investors are no longer willing to pay 100 times earnings for that company.
The source also touches on Tesla here, which feels like, the third rail of investing conversations.
It is, but it fits the pattern. The source notes that Tesla owners often have a near-religious attachment to the car. They love the tech, the acceleration, but that emotional fog makes it very hard to objectively look at automotive sector margins, which are historically razor-thin, or the threat of low-cost Chinese EVs flooding the global market.
You're looking at the dashboard screen, not the balance sheet.
And the market doesn't care about the dashboard screen if the free cash flow yields aren't there.
Okay, so we've established that loving a product is a terrible, terrible due diligence strategy.
Yeah.
But we promised a deep dive, not just a scolding.
Right.
The source pivots to a smarter approach. If I do want to pick stocks, if I refuse to just be a passive indexer, what is the actual checklist?
The source lays out a 4-part framework, and I want to be clear.
Yeah.
This isn't about checking if they have a cool logo. This is about fundamental analysis.
Okay.
And if you aren't willing to do this math, you just shouldn't be buying individual stocks.
All right, step one, the business model. And don't just tell me how they make money. Dig into what we're actually looking for here.
We're looking for unit economics. Does the company make a profit on every single unit sold before overhead? You'd be shocked how many high-growth companies fail this test. They sell $1 for 90 cents and hope to make it up in volume.
This is the customer acquisition cost versus lifetime value equation.
If it costs Allbirds $50 in marketing to sell a pair of shoes that nets them $40 in profit, they are burning cash with every sale.
Not sustainable.
You need to see a path to operating leverage where revenue grows faster than expenses. If revenue goes up 20%, but expenses go up 25%, that's a broken model.
Step two, financial health. This feels particularly relevant given the interest rate environment in 2026.
It's critical. For a decade, money was free. You could run a company with massive debt and just refinance it at 1%. In 2026, that game is over.
Yeah, that's done.
You need to look at the current ratio. Can they pay their short-term bills with their short-term assets?
And free cash flow, right?
Free cash flow is the truth serum. Net income can be manipulated with accounting tricks. Free cash flow is how much actual cash entered the bank account that didn't leave.
As simple as that.
If a company is posting record revenue but negative free cash flow, they are on life support. They will eventually have to raise money by selling more stock, which dilutes you, or taking on high-interest debt, which can kill them.
Which brings us to step three, valuation. This is the one I struggle with because expensive feels so subjective. A stock costs $500, another costs $5. The $500 one isn't necessarily more expensive.
No, share price is completely irrelevant. You have to look at the multiples. Price to earnings, PE, is the classic. But for growth companies that might not have earnings yet, you look at price to sales, or PS.
Let's use the Allbirds example. At the peak, what were we looking at?
At its peak, you were paying something like 20 or 30 times sales.
Okay, break that down for me.
That means if the company paid out 100% of its revenue to you, which is impossible, they have costs, it would still take 30 years to make your money back.
When you frame it that way, it sounds insane.
It is insane. But in the hype cycle, people forget to ask, how many years of earnings am I paying for upfront? If the PE ratio is 80, you are betting that the company will grow into that valuation perfectly for the next decade.
And if they stumble,
you get the 99% drop we saw earlier.
Finally, step four, trend versus fad. This one seems harder to quantify.
It is, but you have to look at TAM, total addressable market. Is the market growing structurally? Cloud computing was a trend. It wasn't going away.
Right.
Home fitness hardware, that's historically a fad. People buy a treadmill, use it for 6 months, and turn it into a clothes rack.
So you have to ask, is this a behavior change for civilization, or is this just the cool thing for Christmas 2024?
Exactly. And honestly, distinguishing between the two is where even the pros get wiped out.
Which leads us to the safety net section of the source.
Correct.
Because I'm listening to you explain unit economics, debt service coverage, PS ratios, and TAM analysis, and I'm thinking, I have a day job. I cannot do this for 20 companies.
And that is the most rational realization an investor can have. If you cannot commit, say, 10 hours a week to analyzing 10K reports, the source is very clear. You should not own individual stocks.
So what's the alternative? The source points to index funds, which sounds kind of boring, but let's explain why it solves the Peloton problem.
It solves the single point of failure risk. When you buy an S&P 500 index fund or a total world stock fund, you are accepting that you won't beat the market.
Oh.
But you also won't get zeroed out by a bad pick.
You own the haystack, not the needle.
Right. But let's go deeper than that cliche. It's about skew. In the stock market, most stocks actually underperform cash over the long run.
Most of them.
Most of them. The market's overall gain comes from a tiny percentage of massive winners. The Nvidias, the Apples, the Amazons.
So if I pick 5 stocks, statistically I'm likely to pick 5 mediocre ones and miss the one superstar that drives all the returns.
Exactly. By owning the index, you guarantee that you own the winners. Yes, you own the losers too. You owned Peloton on the way down. But because it was a tiny percentage of the index, it didn't ruin you.
And at the same time.
Meanwhile, you captured the full upside of the winners. It's about mathematical humility.
Mathematical humility. I like that. It's admitting that you probably aren't smarter than the collective wisdom of the entire market.
And that's a hard pill to swallow, especially for smart people. We all think we have an edge. We all think, I know tech, so I can pick tech stocks.
Of course.
But the source is reminding us that knowing tech is different from knowing how to value a tech company's convertible debt notes.
So if we look back at the people who bought Allbirds at $500, were they stupid?
No, they were enthusiastic consumers. They confused their consumer delight with investor insight. They thought, I love this, so it must be valuable. They forgot to ask at what price.
We've covered a lot of ground here, from the myth of Peter Lynch to the nitty-gritty of PE ratios. If we had to distill this down to a final takeaway for the listener who's looking at their portfolio right now, what is it?
It's to separate your identity from your investments. You can be a Tesla fan, a Peloton rider, or an Allbirds wearer. That's great. Be a consumer. Enjoy the products. But when you toggle over to your brokerage account, you need to turn that part of your brain off.
Put on the cold, unfeeling green eye shades.
Yes. Look at the cash flow. Look at the valuation. And if you don't know how to read the cash flow statement, don't try to be a hero. Buy the index, take the market return, and go enjoy your life.
I want to leave the listener with a thought from the source material that I found it's been sticking with me. It's about the objects in your room right now.
It's a great exercise. Look at your phone, your shoes, the coffee cup on your desk. You know these things intimately. You use them every day.
But ask yourself, do you know their gross margins? Do you know their debt maturity schedule? Do you know if their current stock price implies a 5% growth rate or a 50% growth rate?
If the answer is no, then you don't know the stock. You just know the product. And as we saw with that $1,000 turning into $7,000, that is a very, very expensive distinction to miss.
A sobering check-in for all of us. Thanks for helping us unpack this one.
Always a pleasure.
That's it for this deep dive. Do your homework, check your biases, and we'll see you next time.